let's look at Quasimodo levels. But before the image, I have to show you. Hold on. What we are going to look at, it was actually named after a cartoon character. Some of you probably know him. Quasimodo. Let the image pop up and then I'll show you. This guy, how many of you know this guy? Let me choose one of the images. Which of them should I choose? I want to choose the best one amongst them. Okay, let me choose this one. It was named after this guy, the pattern we are coming to look at. How many of you know this guy? Those of you who used to watch cartoons when you were kids. If you're like me and you watch cartoons when you were a kid, you know this guy. Yeah, Stephen is why he's saying he knows him. So look at him very well. Look at his stature. We are going to talk about it very soon. Look at him very, very well. You see, he has a hunchback. You see, he has a left shoulder and a right shoulder, like every other human being, but he has a very prominent hunchback. Good. We are going to talk about him very soon. Then you'll understand what a Quasimodo level is. So as usual, I'm going to do certain illustrations. Then we go to a live chat and look for examples. Yes. So let me do the illustrations right now. So we go to the main chat and we'll look for examples. Let me get my tools ready. Okay. First of all, let's draw this. Okay, before I even draw this, let me show you this. I believe many of you know this pattern I'm about to draw. How many of you know this pattern? That's the head and shoulder pattern. If you know it, type yes. That's the head and shoulder pattern. Now, this part of this pattern, this part where I'm drawing the horizontal line, the black horizontal line, they refer to it as the neckline. They call it head and shoulder pattern because they compare it to the human body. You see, every human being has a head, has a left shoulder and a right shoulder, unless of course the left shoulder or the right shoulder was cut off, maybe through an accident or something like that. But every normal human being has a left shoulder, a head, and a right shoulder. Now, there's a part of your body that connects your left shoulder to your right shoulder and your head. That is the neck. Okay, so they refer to this line. They refer to this line as the neckline. They refer to it as the neckline, that line right here. Now, what is taught out there as far as retail metrics and retail logic is concerned, this is the rule of head and shoulders. They say that you must first of all wait. When you see it form, you have seen it forming, but you must be patient enough to wait for price to break the neckline like this. Oops. For price to do this, break the neckline like this. Okay, so when there's a breakout of that neckline, you have to wait for price to go back up to test that neckline. Then if that happens, you buy at this point. Sorry, you sell at this point for the market to come down. That is what is taught out there as far as retail logic is concerned. When I say retail logic, I am referring to concepts that were brought to light by retail traders. Retail traders who spent some time with the charts, and through that they were able to identify certain patterns, certain tools, certain behaviors of the market. That's what I refer to as retail metrics or retail logic. So they say that you must wait for the market to break the neckline, come back to test the neckline, then you sell from that level. Okay, that is the logic. So we are coming to look at this. This is a head and shoulder pattern, and I've explained to you what happens in the retail world. So this is your point of interest. If you're a retail trader who goes by retail, or if you're a trader who goes by retail metrics, this is your point of interest. This is where you must be selling from, at that level. First of all, you wait for the market to break the neckline, go back for the retest, then you sell from there. So we're also coming to look at the inverse one before we talk about what we are really here for. We have head and shoulder pattern and inverse head and shoulder pattern. Inverse head and shoulder pattern is head and shoulder pattern turned upside down. So what you're looking at currently is a head and shoulder pattern. Get rid of them individually, because if I click on remove all drawings, I have some annotations on my chart. They will all go, and I don't want to lose them as I need them. So that's how the head and shoulder pattern looks like. This is how the inverse head and shoulder pattern looks. It's a head and shoulder pattern turned upside down, basically speaking. Let me do it properly. Something like this. Good. So this is the inverse head and shoulder pattern. Once again, this point is referred to as the neckline. That is the neckline. So just like the head and shoulder pattern, this is inverse head and shoulder pattern. Simply head and shoulder pattern turned upside down. So according to retail metric, when you see this form on your chart, and you must train your eyes in such a way to be able to identify them, you must first of all wait for the market to break out above the neckline, come back to retest it before you buy it. So if you trade with retail metrics, this should be your point of interest, where I'm highlighting. That is where you should be looking to buy. That is retail logic. So if you want to trade head and shoulder or inverse head and shoulder patterns, those are the rules you must go by according to retail logic. So that's a head and shoulder pattern, and that is how you trade head and shoulder pattern. Okay, so let me get rid of these things and I'll talk about what I am actually going to talk about. So I hope you took note of this structure, because what I'm going to discuss looks very, very, very similar. Looks very, very similar. Once again, let me delete them one by one, so I don't delete everything I have on my chart up there. Okay, so that was retail logic, but then look at it very practically. Let me draw the structure again. I shouldn't have deleted it. Look at something very practically. Why do you have to wait for this to happen before you enter the trade? Why do you have to wait for this? Then you buy at this point. Why do you have to wait that long? When it came here, what were you doing? Were you sleeping? When it came to this level, what were you doing when it came there? Let me use a different color for this one. Let me use this color. What were you doing when the market came here? Were you sleeping? Now let me look through your names. I'm going to choose two people and use them for a certain analogy. I'm going to choose randomly the first two names I see. I've seen Ben Techi and I've also seen David Vodevu. So I'll go by your first names, Ben and David. So let's assume, I'm going to ask you guys a question. Let's assume, and the answer is going to be very obvious. So, but I still have to ask you, even if the answer is obvious. Ben and David are both buying. Ben bought from here. Ben bought from this level where the arrow is pointing at, and David bought at this level. So this is David's arrow. Okay. Which of the two traders do you think is came right on time for the party? This is a party. Okay. Which of them came right? Which of them was right on time for the party? The answer is very obvious. Ben, yes, I like Ben's answer. He said me. Ben obviously was right on time for the party. David is late. Why would you have to wait for it to break the neckline? You have seen this form, but you want to wait for it to break the neckline. Come back to retest it before you get it. So let's compare this with what should I compare it to? Okay, a fufu chop bar. Those of you, if you're on this group and you like fufu like me, then you know the dynamics and what do you call it, tactics as far as eating fufu at a chop bar is concerned. Now, we have foreigners amongst us. We have some South Africans and Kenyans amongst us. You may not know what fufu is, but it's one of the most popular foods in Ghana here. It's one of my favorite foods. Okay. I'm going to use, you probably don't know what it is, but I think you will understand the analogy I'm about to give. But just to give you a heads up, it's a very popular dish in Ghana here. Most Ghanaians like to eat it, including me. Yes, it's one of my favorite foods. Good. So we all know, especially those of you who live in Ghana, and most especially those of you who understand the fufu industry like me. If you understand the fufu industry like me, then you understand the dynamics and the tactics of eating fufu at the chop bar. Now you know that if the chop bar opens at 10 a.m., okay, someone just ate some this afternoon. Ben ate some this afternoon. If the chop bar opens at 10 a.m., if they open, let's say 10 a.m., that is when if you go there at 10 a.m., you get food to eat. That's their official opening time. But then the fufu is ready. If Ben goes there at 10 a.m. to buy, he's going to get fresh fufu with fresh soup and a lot of meat. Everything is there. The taste is fresh. So Ben goes at 10 a.m. to buy it. He's going to get a really, really good taste and he will enjoy the fufu so much. But then David comes at 3 p.m. By 3 p.m., the soup is finished and they have diluted it with water. That's what most chop bars do. The best meat is gone because a lot of guys have come to buy it already. Then the fufu you are going to eat has a lot of what the accounts refer to as aba. Those of you who are accounts, I believe you know what I'm talking about. Now, for those of you who are not Ghanaian and don't know what I'm talking about, the aba is like a part of the fufu that didn't really get pounded well. Fufu is pounded. So because those parts didn't really get pounded well, because they were in a hurry to serve their afternoon customers, you get certain, what word should I use? Let me refer to them as particles. And it's not fun at all when you are eating fufu and you see a lot of those things in it. It's just a cassava that they use that didn't get pounded well. You see it and there's no fun at all. So if David goes at 3 p.m., most of the soup is going to be done and then they'll dilute it. So that means David will not get the original taste. The best meat is already sold. So David may have to settle for amani, dry fish, and maybe some chicken wings or something like that. But Ben went very early. He had the grass cutter to buy. He had the best part of the chicken to buy. He also had the best part of the goat to buy. All these meats are usually available at the chop bar. So definitely between the two, Ben will enjoy his meal more because he will enjoy his meal more because he had the best part of it, and that is because he went in early. Do you get me? David will not, because David came late, and so when he got there, the best part of it was already gone. So he will not enjoy it as much as Ben did. It is exactly the same thing that is happening here. One of the most difficult skills to acquire in trading is entry, like your timing. Most traders don't have a good timing. Most traders don't have a good timing. But with the tool I gave you last week, that is a Cortex theory tool. That tool, if you study it and watch the video that I posted and practice it, it will give you a lot of good entries. Because like I told you, the institutions like to enter at round numbers and exit at round numbers a lot of the time. So if you target some of those numbers, you also be getting very good entries. Okay. So if you want to benefit a lot from good moves, you have to join the market early. Don't come late. Okay. Because look at this example. Look at where David bought and look at where Ben bought. Assuming there is a retracement before the bullish move goes back up. Okay, David entered here. Now let me highlight. Let me not use the arrows again. David entered at this point. That's David's entry. And this is, of course, this is Ben's entry. They are both buying. Now, when David entered, let me bring King David here and put Bernard Dombote here. Let's say after David entered, there was a retracement. The market came to this level before it went up. Do you know what will happen to David? At this point, David will be in losses because of where he entered the trade. Look at where he entered, right where I've highlighted. Now, the market will definitely go up, but it decides to come down a little before, retrace. Look at David's entry. Let's calculate the pips. This is a daily time frame, so that's a lot of movement. So look at where David entered and look at where the market came down before going. All this while while the market moved down to this level, David will be in losses and he may panic and close his losses. But look, Ben is right here. Ben is not yet in losses. The market has not even come to his entry yet. So though Ben's profit will reduce, he's still in profit because he entered at a really good spot, a much better spot than where David entered at. Do you get me? So Ben is safe. David may panic and close his trade because he feels like the market is going down too much. But it comes down to this level, then it goes back up. Then at the end of the day, Ben makes a lot of money. You must not wait for the right shoulder to break this black line, the neckline, and come back to retest it like this before you get in. That is when Quasimodo comes in. Okay? That is when the Quasimodo comes in. So this is what Quasimodo looks like. Let's look at Quasimodo now. Some of them look more complex, but if you practice them a lot, you'll get to spot them, no matter how complex they might appear. I will show you a couple of examples. So we'll look at the Quasimodo and we'll look at the inverse one as well. So once you see this, you see the market do this, and then goes back up and comes down to do this. Immediately draw a horizontal line here, like this. Draw a horizontal line there, like this. Then wait for the market to come here. As soon as it gets here, ladies and gentlemen, sell it. That's your Quasimodo level. Sell it from here. As soon as it gets here, sell it. You don't have to wait for it to come and break this neckline, this neckline down here before you get in. You'll be late to the party. Come to the party late, you don't get nice ladies to dance with. You may have to manage with ladies you may not feel very attracted to. So if you want to get a nice ladies, come to the party early. Do you understand? So you don't have to wait till it comes to break this neckline. Let me change the color to black. Nah, it's a bad entry. I'll not use black because we are black people, so we can't use black. And we'll not use white too because we are not racist. So let's choose a different color, a neutral color. Let's use mauve. Is this mauve? Or whatever they call it. Okay. So this is a bad entry. You don't have to wait for it to do this. You don't have to wait for it to do this before you come and enter over here at this level. We are late to the party, my guy. So this is where you must enter. So as soon as you see this happen, this is an old high. This is an old high. This is an intermediate high. So once you see this happen, you must get in at this level. So you sell from there. Where must be your target? The neckline is, we don't know if the market will break the neckline. You cannot tell. We don't know what will happen when the market gets it. Sometimes it's able to break it. Other times it's not able to. So if you enter from this point, this should be your target. When it gets here, you either close all your trades or you close most of them and leave just one and see if that one will be able to break that level. But then you would have moved your stop loss into about 50 or 40 pips in profit, depending on the number of pips you have made from the trade. Okay, so when it gets here, close it. You can close all your positions or you close some, because we don't know if the market will be able to break the neckline. We cannot tell. It can get here and then decide to come back up. It can do that. By then you will have been out, so you don't care what happens. Or it can just decide to start going down and to not come back to retest. Okay, but it could also break it. And if it does so, if it breaks it and it comes back to retest, you can add more positions there. You have positions up here, you have positions down here. You can add more positions there because that is a retracement. You can add more positions over there. So we'll go to the live chat and look for examples. They are very, very common. These Quasimodo levels, they are very common. They are very, very common. You see them in all the pairs. Let's look for one. Or let's look for some. Like I said, some of them look more complicated than others. Okay, we are more likely to see on smaller time frames. Let's go to 4 hour and see. The reason is because it's a smaller time frame, it has the chance of repeating itself more often than if it's on a bigger time frame. I think I have one example here. Unfortunately, I cannot zoom out for you to see, because I cannot zoom in for you to see. If I zoom in, you will not see what I am trying to point at. Should I get rid of these drawings and do it fresh so you all can see? But I love these drawings, they look beautiful. But I think I may have to get rid of them. Okay, I may not need to delete everything. Let me just get rid of those I don't really need. There's a nice Quasimodo level here, and this is a 4 hour time frame on a USD card. Look at something. I actually see two. We'll look at the small one first, Then we'll look at there's a bigger one. If you have eyes, maybe you can see what I'm seeing. This is a small one I'm talking about. Let's stop here. Let's pause and draw our horizontal line. Can you see what happened? When the market traded back up there, what happened? It dropped. So if you entered here, where would have been our take profit? Now let's zoom in. We may see liquidity over there. Yes. I think there were equal lows there. Yes, look at the equal lows. That's where the whole thing ended. So that could have been your target. I'll zoom back. I'll zoom out again so you see something. So look at what I'm talking about. This is a nice Quasimodo level. Form this old high right here. Went up, it came down first, then went back up to form an intermediate high. As soon as you see this, okay, and now you see that it has come down, you should start targeting this place as a possible sell zone. So look, it went back to that level and see how accurate it was. Look, nice rejection. So assuming this black line here, okay, we said we're going to use a neckline, so let's stick to that. Sometimes a neckline slants like this. This is what I'm talking about. So look at the accuracy. No, but it's supposed to touch here a little, so we will not get. Okay, this is it actually. Like this. Exactly. This is exactly what I'm talking about. See, so this should have been where you be selling from. So anybody who was waiting for it to break the neckline, see, it never broke it. It never broke it. Later it came past it, but then by then the Quasimodo that we identified over here was not valid again. See, it never broke the neckline. So if you entered from here, okay, that is the Quasimodo level. If you entered from here, you see this is an old high. The market came down, went back up to form an intermediate high, came back down. Now, as soon as it started going back up, you should be looking to sell from there. So if you are sold from there and targeted the neckline as your take profit level, how many pips would you have made? Let's calculate it. From this level down to this level, you'd have made 169 pips from this trade by just knowing Quasimodo levels. This is too easy. Free 169 pips. Okay, it's not free. You have to have knowledge before you can make this kind of 169 pips. So I can't say it's free. But what I'm trying to say is it's simple. It's quite simple. You'd have just entered the trade from here. Then you take your profit over here. 169 pips for knowing what a Quasimodo level is. You are out. So look at this. Anybody that was waiting for a break of the neckline wouldn't have had an opportunity to sell this because it never broke it. That's why I told you, personally, I like to target the neckline as my profit target. I don't like to go beyond it because I don't know what will happen when the market gets there. I'm a simple guy. I like to do things I know. Okay. So I do know that when the market gets there, there's a likelihood that it will go back up. So I'll take my profit there. I don't know if it will be able to break it. So you'd have made 169 pips. Cool money. You are out. You are done. So that was a small Quasimodo level. I identified a bigger one too. Actually, there's another small one here. Let's look at that one too before we come to the big one. So you must practice, you must spend time with the charts before you can identify these things. Even if I'm deep asleep and you come and wake me up, you see a Quasimodo, a very complicated one, and you wake me up and show it to me. So I'll ask me, identify the Quasimodo. I'll identify it for you. Look at this example. What should you have done? Take note of your line. Now, there's something you must know. We are supposed to draw it, the horizontal line at the top of the wick. But I realize that some of the time it doesn't go for the wick, it goes for the body. So to cater for that, sometimes I put the horizontal line on the body of the
as soon as you saw this,
but ideally we are supposed to go for the wicks. But I realize that if you go for the wicks all the time, sometimes the market doesn't trade back up to the wick level. It goes for the
now. There's something you must know.
Now,
so we are supposed to draw it, the horizontal line at the top of the wick. But at the top of the wick, I realize that some of the time it doesn't go for the wick, it goes for the body.
It doesn't go for the wick.
So to cater for that, sometimes I put the horizontal line on the body of the candle like this.
On the body of the candle.
But ideally, we are supposed to go for the wicks. But I realize that if you go for the wicks all the time, sometimes the market doesn't trade back up to the wick level. Once they trade back, you miss out this entry. So you can leave the level on the body of the candle. But this is one of the examples where it went. But this is one of the examples where it went. So look at what happened. Okay, so once you saw the market. Okay, let's go back up. So we'll look at you should be targeting 1.32619. As your sell, what price was that? 1.32. What price was that? 619. So that is where you should have been looking to sell this at. So that is where you should have been looking to sell. Once they created this, created this old low, came down, they went back up to create this intermediate term low. Okay. Once you saw the market, going back. Once you saw the market, you should be targeting 1.32619. You should be targeting 1.32619. As yourself. Okay.